$10,000 left in a traditional bank account earns exactly $1 of interest after 12 months, a return so low it's almost an insult. Meanwhile, inflation silently steals $300 of purchasing power from that same $10,000 over the course of a year. Behind the imposing facades of traditional banks, a quiet wealth drain is underway, invisible to most account holders. Large traditional banks currently hold trillions of dollars in customer deposits, paying a paltry average interest rate of just 0.06%. They lend this money out at 7%, pocketing the substantial difference for their shareholders, a practice that raises eyebrows. This legal wealth transfer starts with your checking account sitting idle, earning nothing, a stark reality check. To stem this financial bleed, ranking these accounts from worst to best is essential, beginning with the bottom tier. F-tier accounts, often associated with traditional banks boasting marble pillars, offer no financial benefits, only hefty fees. These institutions demand a $1,500 minimum balance to avoid a $12 monthly maintenance fee, a steep requirement. If your balance dips below this threshold for even an hour, you're hit with a fee that could negate years of potential interest. Moving up to D tier, basic savings accounts from mega banks create an illusion of saving, with little to no actual benefits. These accounts lure customers with $200 sign-up bonuses, but the fine print reveals a requirement to deposit $10,000 in new cash. After the promotional period ends, your money earns nearly nothing, while the bank uses your capital for its own gain. The landscape shifts when entering B tier, where digital-first banks compete aggressively for your business. These online platforms have minimal overhead, allowing them to pass significant savings directly to you, the customer. They offer interest rates over 4%, a stark contrast to the 0.06% from traditional banks, a difference that adds up. At the top, S-tier high-yield savings accounts yield between 4.5 and 5.25%, a significant boost to your savings. With 5% interest, that initial $10,000 earns $500 in a year, a dramatic increase from the $1 earned through traditional accounts. S-tier players like Wealthfront, Marcus, and SoFi have revolutionized banking, bypassing traditional models for a more efficient, customer-centric approach. Many are hesitant to switch due to concerns about the safety and reliability of online banks, a fear that may be misplaced. Every S-tier bank is insured by the FDIC, protecting up to $250,000 per account, the same protection as traditional banks. In the unlikely event an online bank fails, the federal government guarantees the return of your money, a safety net. Choosing the right bank is only half the battle. Managing your credit score is equally crucial for maximizing your financial potential. A common myth suggests carrying a monthly balance on your credit card is necessary for building a good credit score, a misconception. Millions pay 24% interest on a $100 balance, believing it helps their credit score, a costly misunderstanding. Credit card issuers report your balance before you pay it off, so paying in full each month still helps build perfect credit, a more effective strategy. Carrying a balance only serves to transfer your money to credit card companies, not to improve your creditworthiness. Another misconception is that checking your own credit score will harm it, a fear that prevents many from monitoring their financial health. Checking your own score is a soft inquiry, having no impact on your credit profile, a fact that should bring relief. Hard inquiries occur when lenders review your credit for new loans or credit cards, a distinction that's important to understand. A single hard inquiry typically drops your score by fewer than 5 points for a short period, a minor and temporary effect. The credit utilization ratio, which measures how much of your credit limit you use, carries significant weight in determining your credit score. Conventional wisdom advises keeping this ratio below 30%, but top credit scorers aim for under 10%, a more aggressive target. These high achievers pay their bills multiple times a month, a strategy that can significantly boost their credit scores. By making a mid-month payment, you can trick the credit bureaus into seeing a lower balance, instantly improving your score, a clever tactic. This simple trick can raise your credit score by 30 points in under 30 days, without spending an extra dollar, a quick win. With a prime credit score and an S-tier savings account, you've built a solid foundation for your personal finance system, a base for further growth. However, some fall into the optimization trap, constantly chasing minor interest rate differences, a time-consuming and less fruitful pursuit. Moving your life savings every few months to gain an extra $20 in interest is a poor use of your limited time, a lesson in prioritization. Choose a solid, highly rated S-tier account and automate your monthly transfers, a strategy that fosters consistency and growth. Consistency and automation will always outperform attempts to micromanage minor interest rate fluctuations, a principle of effective wealth building. Your financial system should operate silently in the background, freeing you to focus on increasing your primary income, a key to financial freedom. Stop letting traditional banks leverage your savings for their investments. It's time to take control of your financial destiny. Move your emergency fund to an account that pays you a competitive interest rate, a move that aligns your money with your goals. Pay your credit card statements in full every month, starving banks of the high-interest profits they've grown accustomed to, a significant shift in power. True financial leverage belongs to those who understand the system and make informed decisions, not to those who blindly follow the old rules of banking.